We move next to a panel discussion on the theme, the potential of the corporate debt market. The session will be moderated by Mr. Dilshan Veerasekara, the Group Chief Executive of First Capital Holdings.
Ayubowan, and welcome to Invest Sri Lanka 2021, the first virtual investor forum organized by the Colombo Stock Exchange, Ceylon Chamber of Commerce, and the Board of Investment in Sri Lanka. A very warm welcome to all the participants from all over the world. A very good day to you. And today in this forum, we will be discussing the potential of the corporate debt market in Sri Lanka. And joining me today are two very eminent personalities in the capital market sphere. First of all, I would like to introduce Mr. Vishnu Balachandran, who is the Head of Investment Banking at CAL. Good day to you, Vishnu.
Hi, thank you, Dilshan.
And joining us is also Mr. Senaka Kakriwara Godage, who is the CEO of NDB Capital Holdings. A warm welcome to you as well, Senaka.
Dilshan, thanks.
So let's get down to business straight away. And I would pose probably some opening remarks around the corporate debt market from both our panelists. So maybe Vishnu, you can start off. I mean, how do you really see the current status of corporate debt market in Sri Lanka? What are the potential areas for development? What are the opportunities that exist for investors in the corporate debt market space? So maybe around that, if we can get your thoughts.
Dilshan, just to give you a brief background, corporate debt market in Sri Lanka is at its infancy stage, I would say. And compared to the government securities market or the stock market, it's very small or very negligible. And globally, debt markets have been driven by institutional players. But the reason why corporate debt markets haven't really taken off, I would say, in Sri Lanka is that the larger institutions, the pension funds, the provident funds, the insurance companies, have been mandated to have almost 80-85% of the assets in government securities, which leaves them very little assets to go into corporate debt, equity, and so on and so forth. Then comes the second largest set of institutions, which is the mutual funds in Sri Lanka. And these are 90-95% focused on short-term instruments, and there is not much of active participation or contribution they do to the slightly longer-term corporate debt markets in Sri Lanka. And then you also have the retailers who are neither here nor they are kind of when it comes to corporate debt markets. So I would say it's at a really infancy stage. And given that banks have penetrated very well in Sri Lanka, corporates too don't really look at debt markets or capital markets as an alternative source of capital until they have hit their credit limits with the banks. So we see the banks coming repeatedly to raise money for tier 2 capital requirement. A few corporates coming to the market, but not necessarily everyone capitalizing on the infrastructure and the opportunity available to raise money from debt markets. So I think it's at a very infancy stage, and anybody willing to move outside the norm can capitalize and raise money and sustain long-term capital for them.
So the potential is sort of immense.
It's huge.
Any just to elaborate a little bit more, any opportunities that you see that maybe investors should look at in the current context?
In the current context, I would say it's a yield play because Sri Lanka is seeing unprecedented yields in the history of Sri Lanka. And right now, what they would have to do is balance tenure and yield and try and make a play there because that's the best opportunity out there right now.
Thank you, Vishnu. Senaka, if I can get some opening remarks from you around the same in terms of how you see the current status of the market, potential areas for development, opportunities that you see maybe exist even from a foreign investor perspective.
Yeah. Starting with the statistic, the corporate debt market here, the market value, market capitalization of the debt stock here is about 420 billion Sri Lankan rupees, slightly north of $2 billion. And in the context, if you take equity markets, equity market is about 3.2 trillion in terms of market cap, and government securities is about 7.3 trillion. So they are much larger compared to dead stock. So it alludes to the fact what Vishnu also mentioned, it is at a nascent stage or very infant stage. I would say it is mainly because it has been fairly limited to a single sector, banks, finance companies and insurance. So I think in terms of the opportunity, I would say it will be for the other sectors also to come to the corporate debt market, mainly because he mentioned about the demand side as well. It will enable an investor to diversify across the debt portfolio, which is otherwise mainly concentrating in banks and finance today. There had been few corporate debt issues. If you trace back the history, the real growth in Sri Lankan debt market happened in between 2013 to 2016, mainly due to a tax concession the government provided to debt market investors through a waiver of withholding tax. So that created a significant boom in corporate debt market. And I think in certain years, the debt IPOs were bigger than equity IPOs. Sure. So it was a good stepping stone, but then again, market has saturated a bit. So if you take today's situation, probably globally we are in quite a precarious or anomaly situation. I think it's not very, very regularly seen environment coming out of the pandemic. We are at all-time low interest rates, but I think looking at the corporate debt market here, as Vishnu said also, there's a great opportunity for more companies to come in, more companies to issue debt stock, enabling investors, I would say, to ride different phases of the business cycles. Because you might see sometimes the banking cycles and the rest of the economy may not coincide necessarily. So you might have a scenario, more companies coming in, it enables investors to diversify their portfolios and also to follow the portfolio strategies, rebalancing strategies and active portfolio management strategies with that happening. So probably we could expect that in the future.
Great. I'll just draw up again on, I think both of you commented on the fact of a low primary issuance of debt. A large part of that debt, as we know, is the banking and finance sector. Banks really tapping for tier 2 capital purposes, Basel III compliant. That's been the bulk of issuances. So what's really preventing maybe some of the other sectors to come on board? What do you think is required to be done to widen the issuance of debt and get some of the other sectors to come in? Vishnu, if you could touch on that, please.
I would say it's twofold. One is issue education. I mean, it's easy to just classify it into a single word there, but simply put, issuers would come and tell us, hey, banks are lending to me at AWPLR plus half. Why do you want to go double digit for long-term debt? So I think it's issue education with regard to the difference between working capital funding, short-term funding, long-term funding, how you can match your long-term cash flows with debt funding or capital, long-term capital structures of that nature. I think a lot to do with issuer education plays a huge role. The second aspect of it is being that the banking sector is very well penetrated in Sri Lanka. So I wouldn't call it bypassing the banking sector, but creating structures, instruments that the banking sector can provide the funding to the companies as well, but creating structures and instruments which entice the issuers to come up and make issuances into capital markets. I think both those would play a critical role in bringing in more issuers to the market. And that will be a crucial factor in creating, I would say, a change in corporate debt capital markets in Sri Lanka.
Just going from there, Vishnu, how do you see the investor side of it? So if the issuer side needs to be educated, sort of work being done to get more issuances coming in, do you feel the investor side of it is ready for it? Do you think the investors currently, even if you take predominantly which are domestic investors in our listed corporate debt, if we take specifically, do you think that they are open to these instruments?
I would say it's a chicken and egg story. Somebody needs to take the bold move and be that first mover when it comes to testing it out in the market. But from the investor side, to draw in more investors, I would say most of the investors we see today are hold to maturity investors. There is a whole segment of investors who would look at trading opportunities, trading gains, and we are not drawing in that set of investors purely because of lack of liquidity in this market. The Sri Lankan government security market has seen a huge success. I mean, Seneca said that's 7.2 trillion rupees in terms of size. There is daily turnover exceeding 4-5 billion rupees. And there is a reason why that has that kind of attraction, because primary reason is liquidity. I think we need to create that liquidity in the corporate debt market to attract a whole new set of investor base into this equation.
Okay. Senek, if I can move to you and maybe ask you to look at it from a foreign investor perspective. So what do we really need to do to make corporate debt or Sri Lankan corporate debt attractive to foreign investors?
So, Dilshan, if you look at the current scenario, I think we are in a quite a challenging, very volatile interest rate scenario globally. To start with, everyone is operating, developed markets operating near zero interest rates, and Sri Lanka also operating around mid-single-digit interest rates as far as the government securities are concerned, corporate debt at a slightly higher premium. Honestly, I think one challenge Sri Lanka as a country has had over the last couple of years is there had been significant foreign capital migration out of the country, partly coming out of the pandemic situation and flight for safety, as they say. So they've been getting back to safe havens in terms of dollar or some commodities, maybe like gold, and some capital has flighted back out of the country. Equity market has seen it more because of the liquidity situation, but even government securities, we have seen the same thing. But if you look at the long-term trend as far as Sri Lanka is concerned, our average rupee depreciation over the last 10 years would have been around 6%. And that also pushed up a bit over the last 2 years because there had been a steeper depreciation connected to a rating downgrade as a country as well. But if not, our average has been hovering around 4%. So given the very low interest rates in the developed markets, which is near zero, and you add that longer term depreciation, I feel still there's an element of yield opportunity in Sri Lankan debt as well, if you take a medium to long term view or maybe a 5-year plus view. Because if you look at the Sri Lankan situation was really exacerbated by Easter tax, which happened in 2019, and also the pandemic, which almost killed a key significant foreign income earner, which is the tourism sector, which would have been easily by about $4 to $5 billion worth sector by now if we maintain that progress. And given what the government is doing and what private sector is doing to kickstart that sector, and hopefully we'll see the end of the pandemic soon. And once that happens, we'll have this foreign currency cash flows coming in, and also specific efforts have been made for improving exports. And I think we are seeing good progress in terms of that balance of payment issue the country is having. And also the initiatives like Port City will bring in new investments, and we are talking about $4 to $5 billion investments per annum. So if those things come into play, which we think as the medium term opportunities for the country, I think we should be able to see much stable currency as far as the rupee dollar depreciation is concerned. So with that stability coming in, or even if we could go back to a historical average of 3 to 4% rupee depreciation, and the low double digit or high single digit yields will still enable a foreign investor to make an attractive return. And also it's part of the diversification, part of your portfolio strategy, allocating something to frontier markets. And also it could be a little bit of so-called ESG investing, helping a developing country, its emerging economy. I think so there's good opportunity for a foreign investor to play in this Sri Lankan game.
Sure. Yeah, and I think just to add to that, I think also we are probably seeing one of the most liquid markets all over. If you take where monetary easing has the sort of dumped a whole heap of cash out there, and that cash really needs to be invested. So I think you're quite right, Senek. I join in those sentiments, join in that view. I think if you take a longer term view, and I think statistically, if you go back 30 years, the currency depreciation is 4.5%.
Correct.
So that's really, I think, something that the investor should look at. I'll move on back to Vishnu in terms of trying to, I think we briefly touched on this in terms of the secondary market activity. So we see, yes, there are primary issuances, most of it coming from the banking and finance sector. But as you correctly said, there's very little secondary market activity taking place. Why is that? What can be done to maybe activate that and have more liquidity in the secondary market of debt?
Dilshan, we have a very successful government securities market.
Yeah.
And I think all what we have to do is take the learnings from that and replicate it in the corporate debt market. The key success factor there is market makers. and getting market makers involved in corporate debt markets and facilitating that environment through multiple means is something that will get secondary market trading of corporate debt also activated.
Right.
I mean, we have a whole heap of primary dealers in Sri Lanka. I think they would be the front runners into becoming the market makers for corporate debt markets as well. But facilitating how their capital provisioning works when they take positions in corporate debt would be a game changer. Having the ability to repo long-term corporate debt would be a huge game changer because it entices a trader to leverage and trade and make the gains out of it. So that would be a game changer. And having a singular platform.
Right.
I mean, repoing and trading, everything is made easy in the government securities market by having a singular platform. So having a singular platform here would make life easy. And of course, the fourth aspect of it is trading cost. Right now, the trading cost of corporate debt is significantly higher compared to government securities. Yeah, we can argue saying once the volumes are there, it helps the regulator to reduce cost, but I think you need to reduce cost to make that move towards creating an active and liquid secondary market. So I think these four factors would entice a lot of people to become market makers and create a more active and liquid secondary market.
Thank you. Seneka, maybe you can touch upon, we have fairly limited products in our corporate debt market. Plain vanilla sort of products that are on offer. The highest issuances we've seen are debentures that are placed for tier 2 purposes, like we said before. But there are things like green bonds, various other fixed income instruments that trade in more developed markets. How do you see us maybe introducing some of those aspects, some of those products into our market, and how would that sort of help develop the market? Would that be something that foreign investors also look at? Green bonds being, a thing that has been spoken of quite a bit in recent times. What are your thoughts on that?
Certainly. So, as we discussed, the Sri Lankan corporate debt market has been dominated by banks and finance, mainly to meet their capital adequacy requirements through tier 2 capital. However, in the private market, we see a large variety of instruments in not listed debt market, but in the private debt market, mainly in the form of asset-backed securitization, which is a very common instrument for most of the finance companies to securitize their lease receivables, and significant amount of funds are being raised there. And also we have structured some transactions for plantation companies, certain receivables like tea receivables, because the cash flow is trapped and it can be easily securitizable. Instruments have been issued on that, and I think there had been instruments on certain commodities like gold, again in certain finance companies. So that asset-backed securitization market is something that is quite prevalent in the private market. And also we've done through certain private equity funds instruments like convertible debt, which is initially buying into a debenture but subsequently giving you the right to convert it to an ordinary share. So I think some of these structured finance instruments or hybrid instruments, which has the features of both debt and equity, is certainly something foreign investors will look at. Particularly, they might want to get equity exposure of a company, but given the unfamiliarity to Sri Lanka and unfamiliarity to the company, probably they might willing to take a debt exposure. Right. So an instrument like a convertible bond will be significantly meeting that investor requirement. And also from the regulation point of view, a lot of restrictions have been removed in terms of the corporate's ability to borrow in dollars, borrow from overseas sources. And I think recently also for finance companies, the government increased the limit what they could borrow from foreign sources. So I think regulatory wise that progression is happening. So I would say starting with asset-backed securitization is something, a structured product that you have in the market, but gradually expanding into products like hybrid securities, convertible bonds, mezzanine bonds, and touching upon what you said about green bonds. And I think probably last year, 2020 and 21, globally, we have issued about half of the cumulative debt stock in these segments. And also new initiatives like sustainability linked bonds, and these are happening. And I think we saw in equity market, there was good investor appetite for Windforce IPO, which was a renewable energy company. And provided we can have the right scale companies doing these instruments, I'm sure there will be appetite both on debt and equity markets. So certainly it's an option to go for these new instruments.
Sure. Vishnu, if I just roll back to you, I think Senaka alluded to the fact that there is only limited quantity of this debt that's happening on the listed space. There is a lot more probably happening on the unlisted space. Do you think there's something that either the regulator or the stock exchange, is it cumbersome? Is the listing process cumbersome? What can be done to maybe simplify it? How do we get more corporates to essentially come onto the listed space that creates then liquidity on the exchange as opposed to being on the unlisted space where I think a lot of volume happens?
If I may break it up into two, what appeals to the local investors versus what appeals to offshore investors. When it comes to domestic investors, domestic issuers, I think the fundamental difference between why people prefer unlisted markets to listed markets is in the unlisted markets, transactions happen over a term sheet.
Okay.
In the regulated space, there is the whole process of prospectuses and the market timing. And unlike equity, debt is such a I would say volatile product when it comes to quoting rates and the tenor where you can hold it. So it's important that from the time you originate it to the time you close it is a very short time span. And the listed space sometimes does not facilitate that speedy execution. Whereas in the unlisted space, it's a term sheet, you like it, yes, done. So it's a much shorter time frame that you look at in the unlisted space when it comes to debt.
Right.
Equity is a completely different equation, but when it comes to debt, the unlisted space is a much faster and a speedier execution, so people prefer that option. I think when it comes to offshore investors looking at Sri Lanka as an investment route, the fundamental issue there is scale for them.
Okay.
There is a handful of companies who can do $100 million. Everybody else is looking at $5, $10, $15 million. And sometimes for the funds globally to look at Sri Lanka and make an investment, it does not make their analyst time worthwhile to deploy $5 to $10 million. So most of the funding Sri Lanka is getting right now, or the corporates which are getting right now from offshore sources, are actually dollar-linked loans and not really debt instruments that would contribute to debt capital markets. I would say if they look at it, if the global funds can look at it slightly differently, we have had a success factor in this when it comes to private equity funds, when it comes to the equity side. Whereas debt, if they take the view saying, okay, Sri Lanka is in my radar, Sri Lanka is an investable country in my radar, I have approved Sri Lanka, but without spending too much time getting to the breakdown of individual corporates, they co-invest with the Sri Lankan company. I mean, Zephyr has had success doing that in the equity space. They brought on a whole heap of global investors and looking at a co-investment model here. I think debt, we will see much more traction and activity if we can look at similar global funds, looking at similar models when it comes to debt instruments as well.
Thank you. Senaka, I would like to now talk a little bit about maybe historical volatility in rates. Over the last 25, 30 years, we've had huge cycles in rates. Post the end of the war, I think we've had relatively stable inflation, single digit, I think, for the last 10 years or so. But still, we've had some level of volatility in our rupee yields. How do you see that? Is that something that concerns you as a market player? I know from a trader's perspective, volatility is opportunity, but from an issuer's perspective, timing these cycles could be sort of very, very difficult. And from an investor perspective also, if you're not a trader, you may dislike a large amount of volatility on rates. So how do you see that, and what are the things maybe both the issuers and investors can do to protect themselves from that?
Certainly. So I agree with the fact that Sri Lankan rates have been very volatile, say over the last 20 years at least. But I think Sri Lanka as a country has gone through a few unique events as well, which sometimes justifies or which would have been the root cause for such kind of rate volatility. And if you look at the few years before 2009, just before the 3-decade civil war ended, Sri Lankan government was running on a very, very tight budget. The war expenditure on one hand, and a lot of activity in the economy has been curtailed due to the disturbances created by the war. So I think we had high single digits and touching about even 20% in certain cases in terms of interest rates. But after that, I think the risk profile of the country significantly changed, and we saw very stable rate decline from about 2010 to 2016-17 or so. So we had a continuous drop of interest rates. But again, unfortunately, we encountered these few events, the Easter attacks and the pandemic, which again has put certain macroeconomic balances out of equation. So therefore, I think, of course, in terms of giving that liquid to the market, the government is maintaining the low interest rate cycle, but probably as it is predicted around the globe, with inflation picking up again, we can expect the rates to go up. However, I think from an investor's point of view, probably that is one reason in Sri Lanka we have a lot of investors in particularly listed debt instruments as hold to maturity investors, because they don't like that volatility, because which might end up being a significant mark-to-market loss on the books, which probably the investors like banks, which have been the key investor segment of our listed debt market, will not be very comfortable with. And as a solution, I think you need to bring that liquidity in, and probably certain functionalities like market making, where if someone wants to get out of a position, which is facilitated in the market, it attributes to the same thing that we discussed earlier, which is injecting more liquidity into the market. If that is there, I think investors will be probably less concerned about the rate volatility, because it will give them an option of liquidating certain positions, and also, as I said, rebalancing their portfolio. So maybe one sector will be more volatile to the interest rates, but one sector may not be so much, or maybe they are hedged to a certain extent. So it will give them that option of rebalancing the portfolio to get out of it. So in terms of addressing this, I would say the bigger factor would be the macro stability. As I mentioned, hopefully on the exchange rate front, I think there's a lot of initiatives being taken by the government. As I mentioned, Port City project could be one foreign exchange income earner, and import substitution and driving exports to help that balance of payment problem. And hopefully with tourism coming back online, who knows, we might see a rupee appreciation against the dollar. And in certain years we have seen that, because it's such a small economy, and the corrections you need and the amount of BOP change that is required to achieve that is not that significant. So I think it is technically possible, provided we get our act together, and we'll be a little lucky in terms of the pandemic, how it pans out in the next couple of years. So I think the macro stability is a key in terms of getting that stability to the interest rate equation, and improving the liquidity in the market, and also maybe diversifying the companies in the market a bit, so that it enables investor to diversify, and so that your exposure to a certain segment of the economy is not too concentrated.
Thank you, Seneca. Vishnu, moving back to you in terms of maybe looking at new products. I know we discussed that we have fairly simple plain vanilla products in our market, but what are the other products that you see that can be introduced into the corporate debt market here, which are currently not available, and how do you see that sort of?
There's a lot of effort. I mean, I would say all the investment banks would thrive to come and put out new products. It's a mindset factor when it comes to the issuers and investors here. Issuers and investors are so used to seeing plain vanilla products. But that said, okay, we'll have to facilitate looking at providing that sophistication or solution outside the product directly to investors who require it. And I think derivatives is something that is not active here, and or I would say not majorly active here. And having derivative products would mean the international investor community can look at different ways of hedging themselves through some of these risk factors. The lack of liquidity and things like that can be hedged in some way. The FX exposure can be hedged in some way. And these are products I think we can introduce to add a bit more flavor and spice to the investor community. And I think most investment banks are making the efforts in the right direction. But as I said, we only need that one issuer or investor to make that bold move, to be the first mover, to take hold of this. I think everybody is in that shell wanting to see who is going to be, no one wants to be the first mover, I would say. So everybody is waiting there to see, okay, who is going to do it? What is their success story behind it? And how can I replicate it for myself? No one wants to be the first mover. We are personally trying to convince a lot of issuers and investors to look at different products. And I think it's sooner or later that one of these will strike and we will be able to come up and roll out a whole heap of products into the market.
I just want to probe a little bit more, Vishnu, particularly with regard to mortgage-backed securities. I know there's a lot of controversy around mortgage-backed securities stemming from what happened, subprime events and all of that. But very recently, central bank has mandated banks to essentially lend at a fixed rate of 7% on homes. And they expected part of their own growth to be sort of going into that. We've seen, I think, reluctance on the bank's part to probably do that at fixed rates for 10, 15 years when the rates are at a probably historical low in the cycle. So would one solution be then banks being able to really offload from their balance sheet on mortgage-backed securities and effectively utilize their capital more efficiently as opposed to saying, okay, I will lend 7% fixed for 15 years and carry that risk on my balance sheet. So do you see an opportunity there? Do you think our market is ready for it?
I would say in that aspect, it's a pure matching of yield, I would say. Right. I mean, 7% for a debt capital market product, for them to come and take a pure investment decision and take that whole portfolio off the books of the banks. Right now, I don't see it happening. Okay. But in more, I would say, realistic yield levels, right, I would expect it to happen. Because 7%, I think, is a bit artificially driven, a low environment. But I would, and what I also believe is issuers are not going to issue at the highest point of the interest rate cycle, and investors are not going to come in at the lowest point of the interest rate cycle. So I think we are at that point right now. So everybody, most investors who are coming into the market or looking to invest, deploy money in the market, are looking at ways in which they can hedge themselves from the interest rate factor. So they are looking at floating rate options or other swap options to keep themselves hedged against any interest rate movements upwards. So right now, I don't think it's the right time for it, but I think this is definitely a product that the market will be ready to accept at the right yields.
Sure. Seneca, maybe can just probe you a little bit more on some factors that you sort of spoke of earlier, and more looking at also the development financial institutions, which I think your institution has quite a bit of dealings with. What would make it attractive for some of those DFIs to come on board corporate debt? For example, can we even look at maybe private placements of listed debt issuances taking place? Preferential allotment, we know that is there at the discretion of the manager. But maybe what are the aspects you would recommend for issuers and the investment bankers who structure these to build into the instrument that will make it more attractive and be considered for investment from some of these, DFIs that are out there?
What you said is true. In fact, most of the DFIs also, I think even very recently, we managed to get a couple of DFIs into various instruments, both debt and equity. And one thing I can say is DFI interest is very much there as far as Sri Lanka is concerned. Particularly, again, stemming from the large liquidity portions that they are also carrying, coming from various injections happening all over the world. So with regard to listed debt market, there are multiple ways we can get them involved. One, as you said, CSE has allowed about up to 75% preferential allocation. So even if you do a large size, even up to 75%, certain quantum can be assured for these investors. So that will enable them to take meaningful positions as far as their portfolios are concerned. Another way I see how they could get involved probably is by guaranteeing some of these instruments, some sort of an underwriting function, right, where they might be able to earn a fee and also take a position. And also another thing that we have done with regard to DFIs and also overseas funds is introduce this concept of cornerstone investor, which we've done for both debt and equity instruments as well, where you allocate a certain portion of the issue to one or two dedicated investors. So again, depending on the appetite of these investors, they can take a large chunk of the issuance. So those are the ways that you could mainly participate in listed debt issuance. And it is similar to a private placement, which you do through a listed debt issue, because you identify a certain quantum, certain component with a particular investor. So essentially boils down to a private placement, but inside a bigger listed debt issue. And there are other ways of doing this. I think we have looked at many loan syndications with DFIs, again coming from bank and finance sector largely to meet their Tier 2 capital requirements. But with certain corporates also, particularly if the corporate has, let's say, significant export proceeds, we can think of structuring certain dollar bonds where even currency risk to a certain extent is minimized. And also for renewable energy, sectors like renewable energy, where the companies need longer term capital, where typically the banking system here still probably is not going for 15-year plus tenors. You might see probably it stopping at 10 to 12-year tenors mostly. But these DFIs with their development angles as well, they need to promote development and sustainability in these economies. They would like to take these longer portions. We've had several conversations with regard to that. So that's another area we are looking at, particularly in terms of renewable energy bonds or renewable energy instruments, where these DFIs can take a longer exposure. But to be honest, one challenge remains, which is the currency risk, which needs to be hedged to a certain extent. And in Sri Lanka, I think that is something that you don't have today, being able to hedge your risk in the long run. So still it will expose them to a currency risk, but particularly for DFIs, still it could be an acceptable risk with the development angle and the sustainability angle coming out of some of these.
And also I think taking the longer term view that, the currency depreciates average of 4%. Exactly. So as long as you have a positive yield. Yeah.
No, but I also guess that the DFIs have their own means of
hedging.
Hedging.
Yes.
So, I mean, while the investor community here is capped at about 12 months for their hedging requirements.
Sure.
DFIs have their means to go up to 7-10 years for hedging requirements. So I think for them, currency risk is less of a concern.
Right.
It's more to do with the country's credit risk rating and things like that. So,
right. Just looking at the investor side, the investor education aspect, and the public being aware of the different, corporate debt instruments out there. I feel that, Sri Lankans as a nation of savers, typically everyone has a bank account. I think penetration is probably almost 100%. But people don't know, or the vast majority of people don't know anything beyond a savings account or a fixed deposit. And I think that probably limits, you coming into and making those investments. So just posing this question to both of you, what do you think that the government, the regulator, the various stakeholders can do to maybe change that perception? Because if you look at, just take neighboring India, the mutual fund industry is larger than the bank deposit basis, and people are used to, other alternative, innovative investment products. What do you think needs to be done? So maybe Vishnu, you can go first, and then I'll direct the same question.
I would say it's a question of getting the word out. I mean, Colombo, yes, the business community, I would say the active investor community knows about mutual funds, knows about wealth management and the solutions out there. Yes, so it's a question of getting the word of mouth out there more in a more active environment. And the second thing would be, I would say, the yield difference that comes through a simple deposit.
Sure.
Versus a wealth management solution or a mutual fund that is out there. And wider the differential, the more people are attracted to it, because people are yield hungry always. Banks can offer 10-12%, people will look for 14-15%. Today, people are happy with 7-8% because banks are offering 3.5 to 4%. So I think the wider the gap, the fund management solution people and also the capital market instruments provide, I think the easier it is to get the attention of people as well as loop them into the equation. So there have been patches in Sri Lanka where this gap has been wide.
Right.
There have been patches where the equation has been inverse, where the capital market solutions and mutual funds and wealth management solutions have yielded lower.
Right.
There have been instances where it has been neck to neck. So I think the best time to loop the people in is when that yield gap is wide, which is right now. Right now, you're talking about 4 to 5% difference sometimes.
Senak, if I can move to you.
So I think we can do a lot in terms of corporate debt market, both on the demand and supply side. Starting on the supply side, as we discussed, so probably still that education element has to happen, further reinforcing what are the advantages you can get from a debt market compared to traditional bank-based borrowings, particularly the things like the ability to go for longer tenors, being able to borrow without collateral, and also maybe providing those hybrid instruments where instruments like convertible bonds would be a reality, which will be difficult in a traditional market. So I think issue education, and also I think the role is up to us, the investment bankers, to convince them, look, it's a good opportunity. The yield is one thing, but the longer term benefits that could accrue to a company in terms of securing longer term capital, which enable you to have a clear visibility about your funding pipeline, and also some of the instruments that will give you the best combination of cost of funds at a given situation. So that's mostly on the supply side. But on the demand side also, I think Vishnu alluded to the fact that certain things we could do in terms of maybe getting primary dealers to repo the instrument so that more liquidity will be injected to the instrument. But also even the simple investors, I think probably the city-based investors will have a decent idea. But when you go outside the city and probably at the grassroots level, still, I would say the knowledge on corporate debt is not that strong. And even if you take the broker community of stock exchange, which is licensed to sell this debt, I'm not too sure whether their knowledge levels are the best in terms of the corporate debt markets and trading debt and so on. So I think still education elements can improve, telling them how to sell these, what factors you should focus in, what would be the advantage to an investor at a given point of time. So I think that education element could go a long way. So we saw last year and this year during the pandemic, a lot of new accounts were opened, new investors came on board for Colombo Stock Exchange. And I think even with those investors, if we could market the corporate debt market as well, so I'm sure some of them would think about, because they may be having just a savings account or a fixed deposit in a banking system. So giving a flavor of corporate debt, I'm sure you'll be able to convert some of them into capital market investors as well. So I think on supply side, convincing the issuers about the benefits and actually what they could tap into through a corporate debt, and also on the supplies on the demand side, the benefits both on the intermediaries like the brokers as well as the ultimate investors. I think education could go a long way in terms of improving the market.
Great, yeah, because I think even we don't really cover that in the curriculum of even schools, and that's something that I think is needed now. That essentially, when you come out into maybe the working community, that you're aware of what options are there. So that's one thing. We've had a great discussion, so I'll just like to maybe sort of give you gentlemen a chance to recap some key thoughts that you want to express, and maybe closing remarks. So Vishnu, if you would like to go first.
I think the crucial factor to note is, with the pandemic, there's always a knee-jerk reaction by all the institutional investors. Seneca pointed out that there was a outflow of capital, people selling out and liquidating positions in bond markets, equity markets. Even Sri Lanka's sovereign bond was trading at close to 45-50% in terms of yield. There was a credit downgrade, and everything looked like a doomsday scenario. But I think that is reversing itself. Yields are back at about 15 to 16%. Sri Lankan ISBs were the best performing bond in the region in recent times. Sri Lanka has shown its commitment to repay on scheduled dates. So I think as a country, we are showing the indications are heading in the right direction. And in terms of a global investor or an international investor, this is the best time to capitalize on, I would say, the hybrid situation. Things are not the greatest, but they're heading in the right direction. Invest today so that you get the best yield and you can make a yield play on a country, which I strongly believe is going to have its credentials heading in the right direction. So we are going to see our, I would say, statistics improve, our rating improve. So this might be the right time to capitalize on that. Come in, invest, get the good yield, and have a good backing here.
Great. Seneka?
So to reiterate what I said earlier also, I think the main concern of a foreign investor would be the rupee depreciation against the dollar. So as I said, there's several initiatives taken by the government and also the private sector in terms of improving the country's balance of payment situation. And with an improvement, hopefully we'll see a moderate depreciation, or at best case we might see some appreciation as well. Because I mean, don't forget, globally also there's a significant liquidity injection, and the currencies like US dollar has seen this depreciation vis-a-vis some other global currencies as well. So what we say is, I think as a country, there's a lot of measures taken, and then also we are, as I said, it's a very, very unique situation. Several negative factors happen on 2-3 consecutive years, the Easter tax, the pandemic, and so on. So I think with exports improving and several import substitution drives happening, Port City project hopefully bringing in a significant amount of FDIs into the country, and pandemic recovery enabling us to recover the tourism sector, which is on the minimum should earn about $4 to $5 billion, which will go a long way in plugging our balance of payment deficit. And also the foreign debt repayments, with some of this being restructured and new investments coming in, I think we'll get to a situation where and only upside is possible compared to where we are today. And with that, as Vishnu said, there may be rating enhancements. So I think from a foreign investor's point of view, we should take that medium to long-term outlook, which is, I would say, 5+ year outlook. I'm sure there's a lot of positives on the card, what we could offer as a country. I think if you come to the market today, or if you look at the investing in Sri Lanka today, I think it will be a great pedestal which you can grow from, given the macro improvements that we could expect over the medium term.
Great. So I think we've come to the end of the discussion, and I would like to thank Vishnu and Seneka for contributing to this discussion. I think you've heard it, that there is certainly a case to invest in Sri Lanka, and there's certainly a case to invest in the corporate debt market of Sri Lanka. We've discussed various initiatives that are taking place. We've discussed the options out there, but also the developments that the regulator, the markets are looking at. So we certainly hope it's been insightful for all our participants, and that you would take this opportunity and really come and invest in Sri Lanka. So thanking all of you for your participation. Wish you a good day.
Thanks,
guys. Thank you.